Have you ever looked at a stock after it's doubled and thought to yourself, why didn't I buy that earlier? Well, the truth is, professional investors don't have a crystal ball. They simply follow a process. Before buying any stock, Wall Street analysts typically look at four things: price targets, earnings expectations, analyst ratings, and momentum. In today's video, I'm going to show you exactly how to use these tools so you can research stocks like a professional investor, even if you're a complete beginner. Let's start with price targets. When you hear an analyst say they have a price target of $150 on a stock, what does that actually mean? A price target is simply an analyst's estimate of what a stock could be worth over the next 12 months. For example, let's say AMD is currently trading at $120 per share. If analysts have an average price target of $145, that suggests around 21% upside from current prices. Sounds great, right? Well, here's the important part. Price targets are not predictions. They're educated estimates based on assumptions. If those assumptions change, the price target changes too. Analysts often create multiple scenarios. The bull case assumes everything goes right. The base case assumes things go as expected. And the bear case assumes weaker growth or unexpected problems. Imagine AMD. The bull case might be $170. The base case, $145. The bear case, $100. As investors, our job isn't to blindly follow price targets. It's to ask, what assumptions are analysts making, and do I agree with them? Because sometimes the market is already pricing in the good news. Next up, earnings. If stock prices have a heartbeat, earnings are usually what make that heartbeat speed up. Every quarter, companies release earnings reports. These reports tell investors how the business is performing. There are three numbers I always focus on: revenue, EPS, and guidance. Revenue is simply how much money the company generated. EPS stands for earnings per share. Think of EPS as the company's profit divided among shareholders. Suppose analysts expect a company to earn $1.20 per share. Instead, it reports $1.45. That's called an earnings beat. Normally, you'd expect the stock to rise. But here's where investing gets interesting. Sometimes companies beat earnings and the stock still falls. Why? Because expectations were already too high. This happened to many great companies throughout history. Even companies like Netflix, Nvidia, and Tesla have seen their stocks fall after reporting strong numbers. Remember this: the market doesn't react to good or bad news. It reacts to news relative to expectations. Now let's talk about analyst ratings. You've probably seen terms like buy, hold, or sell. But what do they actually mean? A buy rating means an analyst expects the stock to outperform. A hold rating suggests limited upside. And a sell rating means they expect underperformance. Sounds simple. But here's something many new investors don't realize. Analysts are often late. Imagine a stock rises 50%. Only then do analysts upgrade it. By that point, much of the move may have already happened. This doesn't mean analyst research is useless. Far from it. Analyst reports can provide valuable insights into a company's business and future growth. But I treat analyst opinions as one input, not the final decision. Price action often tells the story before analysts do. Let's move on to momentum. Momentum is one of the strongest forces in investing. There's an old saying on Wall Street: the trend is your friend. Many of the best performing stocks continue performing well for months or even years. So what do I look for? First, I look for stocks near their 52-week highs. Strong stocks often keep making new highs. Second, I look for stocks trading above their 50-day moving average. This helps identify whether the stock is in an uptrend. Third, I check trading volume. High volume can indicate that large institutions are buying. And finally, I look at sector strength. Money tends to move in themes. Over the last few years, sectors like AI, semiconductors, cybersecurity, and healthcare have shown strong momentum. Examples include companies like AMD, Micron, Palantir, and Eli Lilly. Strong stocks in strong sectors often have the best chance of continuing higher. So before I buy any stock, I ask myself 4 questions. Number 1, is revenue growing? Number 2, did the company beat earnings expectations? Number 3, is the stock in an uptrend? And number 4, do analysts still see upside? If at least 3 out of 4 boxes are checked, the stock goes onto my watch list. Notice I said watch list, not buy immediately. Patience is one of the most underrated investing skills. Sometimes the best trade is waiting for the right entry. Great investing isn't about predicting the future. Nobody knows exactly what stocks will do tomorrow. Successful investors simply stack probabilities in their favor. By understanding price targets, earnings, analyst ratings, and momentum, you can dramatically improve your decision-making and avoid many of the mistakes beginner investors make. If you found this video useful, consider subscribing to the AI Wealth Desk for more investing insights and market analysis. And in the comments below, let me know, which stock should I analyze next? Thanks for watching, and I'll see you in the next video.